So section C, we are going to be attempting the March-June 2022 past paper question. So I hope all of you know how to access the practice platform and use it. So since this is FM, I think you might have done certain other subjects, so you might be familiar with it. So that is my assumption that you know it. If you don't know how to access it, please let me know. I will go through it. But if you are okay, then we can continue. Okay, so we are going to try March-June 2022 question, Melplash Co. Melplash Co. I don't know how that's pronounced. Melp slash, whatever. Okay. Okay. So everyone, open the practice platform. We're going to attempt the question. Okay. Get ready. Open it. Quick, quick, quick. Don't waste the time. Okay. Shall we read? Let's read. FM is your first exam. Okay. Florida, do you know how to access the practice platform? No. So log into your MyACC account. Log into your MyACC account. So once you log into your MyACC account, so Florida, once you log into your MyACC account, go to My Qualification, scroll down, click on CB Practice Platform. Okay, My Qualification, click on CB Practice Platform. Okay, Florida, got that? Florida, are you okay? Yes. So go to the March June 22 question. So basically, click on the FM tab, Financial Management. Click on ACC Official Resources, Past Exam Library, and then Assign. Click on Assign. March June 22, Assign. Then it'll appear somewhere over here. You can just start it. Okay. So let's read the question. Melplash Co manufactures motorcycles and is considering an investment in a new high performance model. The market for high performance motorcycles is very competitive, and Melplash Co's directors want to recover the cost of the investment in the model quickly before it is made obsolete by more advanced models at the end of the 4 years. Directors also wish to show shareholders that the investment will be profitable. Okay. Directors have therefore set a large payback period, a target payback period of 2 years, and a target return on capital employed of 20% for the investment. The directors have also asked the finance director to provide the NPV and IRR calculations for the investment. They plan to consider the results of this calculation and if the investment fulfills the target for payback and ROCE. Whiplash has prepared the following forecast of production and sales of the new model. Okay, production and sales are given. Melplash Co's finance director has prepared the following information relating to the investment proposal. Information is given. So requirement one, for the proposed investment, calculate the NPV, net present value. NPV. How many years? 4 year project. Year zero, year one, year two, year three, year four. So starting off with the investment. Investment. Initial investment is 220 million. So this is a small point. You can do the question in millions. You can do the question in thousands. You can do the question whatever the method which you want. But remember, whatever the method which you are using, mention it. So mention all figures are given in millions. Mention it. And it's fine. If not okay. 220 million. Yeah, one. Next, sales. Okay, one. Selling price. Selling price. So selling price, year one, year two, year three, year four. Then you have the units, the total sales. Selling price. They have what is the year one selling price? Year one selling price. What is the year one selling price? Yes, students, tell me year one selling price is. Yeah, what is the value? Value is, should we inflate that 20,000? For year one, should we inflate it? Should we inflate it? No need to inflate. Why don't we need to inflate? Because it's already given in year one terms. So we don't have to do inflation for year one. Okay, so that is 20,000. What about year two? We have to do the inflation. 20,000 into how much? 6% per year. 1.06 to the power of 1. Power of 2 to the power of 3. Units 25,000, 45,000, 40,000, 20,000. Okay. So sales is, remember again important, always link the sales, link your workings. Okay, so continuing on, sales is given the figures. Okay. Next. What next? Variable cost. Working 2. Okay. So here 1, variable cost per unit. How much is that? 14,000 per unit. Okay. Remember, they have given in year 1 term. So year 1, we don't have to inflate it. Year 2, 14,000 into 6%. That's also 6%. 1.06 to the power of 1. Power of 2 to the power of 3. Number of units, same thing. Okay. And remember, costs, your expenses, cash outflow are always negative values. It should be negative values. Variable cost. Next, fixed cost. Fixed cost. Year 1 fixed cost is 120 million, which is inflating by 10% each year. Are you there? Next, what do you have? Selling price is okay. Residual value, scrap value. Do you have taxation? Anything else missing? No. We just need the scrap value. Scrap value is 30 million. So net cash flows in PV based on the money rate. Okay, equals NPV, open the brackets, 14%, comma, year 1 to year 4 plus year 0. NPV calculation clear? NPV is clear? NPV is clear? All good? This is okay? Rate is 14%. Enough rate is 14%. Hurry. Requirement to IRR. Okay. So even though you have the workings over here, better if you just copy this. Same thing. To copy it's not difficult, no? Just copy it. Just we'll change the formula. Copy करला formula का मार्ग We'll change the formula. IRR equals IRR. Open the brackets here 0 to here. Close the brackets. IRR. Simple. Okay. IRR is clear. It should be a person. Should be a percentage. 17.070%. IRR is okay. Okay, IRR. Can I yes if I move on? Okay. Next. Payback period. So payback period, we need the cash flows. So payback period, again, we need the cash flows. Payback period. Okay, so what is the investment which you have to recover? Initial investment is year zero. Investment amount is 220 million has to be recovered. From that year one, what is the inflow? Net cash flow is 30,000. Year two, what is the net cash flow? Year two, we are getting 154. And remaining year three, we are getting a cash flow of 124, 42, 464. Okay, then how do you calculate the payback period for that? Okay, payback period is remaining cash flow over the next year's cash flow. So remaining cash flow is 35.8 over next year's cash flow is this amount plus what? How many years already gone? 2 years. Payback period is 2.28. Is this clear? Payback period. Again, very simple calculations, man. See, very easy. Section C, very easy. Piece of cake. Next, ROCE based on average investment. Based on average investment. Balam. Average investment. Average investment is what? Investment plus scrap value divided by 2. 220 million plus scrap value. Here, this is scrap value. 30 million divided by 125. Next, average profits. Average profits. How do you calculate average profits? We have the cash flows. Year one, year two, year three, year four. Cash flows are there. How much are the cash flows? Let's get the cash flows. Cash flow minus the depreciation. Cash flow minus the depreciation. How much is the depreciation? 220 plus 30 divided by 4 minus value. Profits. Then total profit is average profit ROCE, this over the average investment. This is your ROCE. Clear? Unless once ROCE is clear, again, very, very easy, man. Not even a problem. Year 4 cash flow has included the year 4 cash flow. Where are you, man? That's in years. No, yes, that's in years. Payback period. This is in years. This is in years. How did you calculate the depreciation, Florida? In investment minus the scrap value. Investment minus the scrap value divided by 4, Florida. That is investment minus the scrap value divided by 4. Okay. And along with that, over here in the year 4's cash flow, something is included. No, what is included? Uh, the scrap value is included. Let's remove the scrap value. Okay, you should not include the scrap value. You should take operating cash flows. ROCE, okay. How many marks? 5, 7, 9, 12. 12 marks. Got 12 marks. Simple 12 marks, man. You have, like this, you can't get in any other subject. Like this easy, you can't get 12 marks. Is this question okay? Clear for everyone? Can I have a yes? All 18 of y'all? Can I have a yes? Yes. Good. Keep the screen for a while. Fine. Fatima, Zakia, and Dul Nadi. Which batch are you all from? This is the first time I'm seeing your names in the chat box, man. Fatima, Zakia, and Dul Nadi. Which batch are you all from? September. September. Okay, September 24. Is it? Okay, I don't remember. Once all are done taking down, let me know. We can continue. Okay, done. Completed online students. Completed. Going on. Requirement B. Discuss the suitability of the techniques used in requirement A for determining whether to undertake an investment and advise with the Melplash Co. whose proposed investment is financially acceptable. Okay. Now, writing part. Section C, writing part. Always remember FM, you have writing 50-50. They will try to make it 50-50. 10 marks writing, 10 marks numbers. Maximum, they'll try to make it like that. Okay. Okay, Dveshkar. I'll share the answer with you, Dveshkar, after the class. After the class, I'll share it with you all. Okay, Dveshkar. So if you want to improve on this writing part, you have to read the technical articles. Without reading the technical articles, you difficult to attempt the writing part of section C. So again, technical articles, that is not something optional which I'm giving you. Remember, theory classes, QBR classes, technical articles, revision kit, mock exams. Oh, come on, this is not optional stuff, mandatory to pass. You have to read the technical articles. So for now, let's start with the question suitability of the techniques. So what are the techniques? We used NPV, we used IRR, we used ROCE, we used the payback period. We have to talk about all of this. Okay. Starting with net present value. Okay. So first off, we have to describe it. We have to tell what is NPV. What is NPV? Okay. The NPV. So in requirement number three, do we need to calculate a normal payback? Because they didn't ask discounted, no, right? Yeah, they just said payback, so normal payback. The NPV is the NPV uses cash flows rather than profits. It measures the absolute return to the company. Okay. Melplash Co. Should we accept the project according to NPV or should we reject it? Accept or reject. According to NPV, accept or reject. Accept it. Why? Positive NPV. Should accept this project as it has a positive NP and therefore would increase shareholder wealth. Okay, fine. Anything else which we can mention? We can mention here. NPV also takes into account time value of money and looks at the entire life of the project. Yeah. Internal rate of return. IRR measures the rate at which the NPV becomes zero. Okay. IRR is a relative measure. IRR is a relative measure. IRR takes into account the entire life of the project, take into account cash flows, time value of money, and looks at the entire life of the project. According to IRR, should we accept this project or reject this project? According to IRR, what should we do? What is the IRR? IRR is 17.7%. IRR should be compared with the cost of capital. Our IRR is greater than the cost of capital. So should we accept the project or reject the project? What should we do? Online students, what should we do? We have to accept the project. Plashco should accept the project in accordance with IRR as it is higher than the cost of capital. the company. Okay. Ahnaf, still I didn't understand. Relative concept means Ahnaf, you have to compare it. Relative. That means if it's a percentage, if it's a ratio, that means it's a relative measure. So NPV, you don't need to compare project A's NPV with project B's NPV to make a decision. If project A's NPV is positive, we will go ahead. You don't need to compare it. But IRR, you have to compare the IRR, the cost of capital. Relative measure should be compared. Next, payback period. The payback period measures the amount of time it takes for the company to recover its initial investment. It takes into account cash flows, but does not look at the entire life of the project, nor does it take into account the time value of money. According to IRR, should the company accept the project or not accept? What should we do? What is our payback period? 2.28 years or 2.3 years. What is the target payback period? 2 years. So our payback period is greater than the target payback period. We are taking more time. Then should we accept or reject? Enough, accept or reject. We have to reject it. We have to reject it. According to the payback period, Ash should reject the project as it is greater than the target payback period. Final one, ROCE. Okay. The ROCE measures the average return of the project based on the average investment. It does not take into account cash flows, rather, it uses profits. Okay. Next, okay, what should we say? According to the ROCE, Melplash, should we accept or reject the project? We have to accept the project. Why? Our ROCE is greater than the target ROCE. Should accept the project as it is greater than the target ROCE. Finally, what do you do? Advice. What advice are we going to give? What is the advice? What should we do? Should we undertake the investment or should we not undertake the investment? We should take the investment. Why? Because always remember NPV is the superior method. If NPV tells you to do something, you do something. Okay. So according based on three of the four investment appraisal methods used, all except payback say to accept the project. Melplash Co should accept this project mainly based on the NPV as it is positive, it will increase the shareholder wealth. Simple as that. Easy, easy, very easy. Done. Clear? Is this clear?